I hate to be an I told you so, but I did. And we are now, this is what the other side of a policy error looks like. The Fed, I think it would be, I mean, at this point, unthinkably undisputed that the Fed made a mistake raising interest rates into a slowing global economy. I've talked about the litany of horrors. I'll go over them really quickly here. Everyone keeps pointing to how great the jobs numbers are. Those jobs numbers are bullshit. Sorry, but they are. Everybody knows the truth that the 5% is a number that's made up. It's fictitious. The jobs that were added were a lot of temporary hires for holiday workers. They were lower quality, lower paying jobs, and I'm really curious to see how this is going to play out in the next jobs number now that those are done. And we're probably going to see rounds and rounds of layoffs in the energy sector and retail. We know that Macy's is closing a lot of stores. Walmart is closing a lot of stores. This is not good for the economy. GDP is pretty much in the tank. The Atlanta Fed has lowered their forecasts. The investment banks are all in like a who's race to lower their GDP forecast to who can be lower. I guess that's the new in vogue cocktail party, whose GDP estimates are the lowest, and of course that being that, and whose oil estimates could be the lowest. ISM we know is terrible. Everyone keeps talking about, that we're not a manufacturing company and we have a manufacturing recession and it's not a big deal because we're a service nation. The only bad news is that the service was negative as well. Not good. Recessionary, both numbers below 50. The PMI also recessionary, not good. Durable goods orders, everyone, I think the president gave a speech today citing how great the auto sales are. That to me sounds like the top. If people are losing their jobs, if credit isn't going to be as available, it's going to be harder to get auto loans, particularly in those areas where a lot of the employment was because of the energy revolution. Same thing goes for housing, same kind of spiel. So the dollar is still quite high. I think it's been playing second fiddle to the problem in oil. It's staying stubbornly high. It's been mentioned on some conference calls already for its strength, and that is troublesome. It's not necessarily breaking through the highs yet, but it doesn't even need to. It just needs to stay stubbornly high, and it can be a problem. It's interesting to me, and I can't say that it's so unpredicted, that the bonds, bonds in TLT terms, they had a bit of a reversal topping tail today, but they did happen to close at above the kind of the recent range high. That being 126.37, I believe. No, sorry, that was the gap fill. The range high I had is 126.21, so kind of close. But that did sell off a bit, but that doesn't matter. The Fed, when they raise rates, interest rates should be going lower. Interest rates should be going higher. Instead, they're going lower, and I think that's because people realize that there is no growth, that there is a flight to safety, and that it's a risk-off mode. So the fact that the Fed raised rates and rates went, or quote-unquote raised rates, but the rates went lower is very troublesome. The Fed should be paying attention to this. I see a few people making comments about my attire, that I'm not wearing black. I am wearing black under here, but I thought since we were in such a bearish red market that I would have my red party dress on, so to speak, my deflationary hoodie here. So yeah, blood is in the streets today for sure. So let's talk about some of the components here of what's going on in the market and what's leading us down and what we'll need to see change for any type of sustainable rally. So first and foremost, we all know is oil. I've been beating that drum for a while, and I would say at this point it has gone well past where I thought it would stop. I was right a couple of times on playing bounces, but it is definitely lower for longer as well. I think that all isn't necessarily lost here, at least short term. I'm going to discuss a little bit of where I could see oil going. I discussed in the weekend review that 25, 26-ish could probably be a short-term node, at least for a bounce, if not below. It's very possible. At this point, everyone seems to be placing where they think, kind of placing their bets on how far oil can go down, where they think it's going to rally from, and the truth is that commodities and stocks and any assets can go a lot lower than people realize, particularly in the initial stages. So 25, 26 is an important level. This is all, by the way, as long as we're below 33.20. If we can get back up above 33.20 and 37, then I would say things are kind of, we may have seen the worst of it. But as long as we're below those levels, we have to start thinking about downside levels. And unfortunately, there isn't really that much down here. There's the 25, 26 area. We stopped today in the 27s. Also at a sort of a channel low within a bigger channel context. There's also the 17s and then the 10s. I know Goldman Sachs, someone just mentioned, had called 20. I kind of had thought that would be them jumping the shark, sort of like at the top of the range, them saying oil was going to be 200 and 300 and we saw peak oil. Now I hear people talking about, how oil is going to go out of style and we're never going to use it again, and it's all wind and renewables. I assure you that we are decades away from that. Buildings rely on boilers with heat. These are huge capital expenditures, and they're not going to be made very lightly. We are built on an auto infrastructure. There are millions of people. They're not going to spend more money on. Listen, as nice and fine of a car as a Tesla is, or that BMW i8 that I've been scoping. I'm thinking about anyway. Most people can't afford those types of cars, and I'll tell you that it's going to take quite a while for the market for that to change. It may be moving in that direction. I'm willing to concede that, but it isn't going to be an overnight thing. China and India, their demand is higher than it was back when oil was back at these levels. However, we do have increased supply. We know Iran is coming on. We know the Saudis are trying to compete. And we also have the energy revolution that has happened here. The problem is that a lot of these companies, and this is the reason for why oil is so important and why it's hurting the market, is a lot of these companies aren't Exxon and Chevron, although they sure took a beating today, those two. They are smaller, and they are financed heavily on debt, and they also require oil to be higher. I would imagine there are probably some debt covenants in their, with regard to oil price in their loans. But even beyond that, they need a higher price to break even. And when you have a problem of paying off debts and trying to stay in business, they're not stopping pumping at these lower levels. They're actually probably pumping the same or as much as they can to get, it's sort of like, there was an experiment. It's a very Nazi-like, inhumane experiment, in my opinion, but it is a very famous one nonetheless. And it is called The Mouse and the Bell. And it's a very famous, they take a mouse, they put a glass cover over it, a bell, and in the beginning the mouse is breathing normally, and by the end it's hyperventilating. With each breath it draws it is closer to its own death because it's depleting the oxygen within the bell. And eventually we know what happens. Either the experimenter raises the bell and the mouse gets to live, or they die. And this is the problem that these companies are facing, that they are pumping and pumping, that's their version of drawing their breaths, in a decreasing environment, meaning the price of oil is going lower. So that's the nearest analogy. I know it's a little grim and sadistic, but oil is down from like over $100 basically in a row. So I'm in a little bit of a grim kind of mood. So that's the story. So there's debt covenant. Anyway, that debt has been packaged and is part of, it's securitized, very similar to what happened with the housing market, and this stuff is going to blow up probably. And, I don't necessarily know if we're going to have the house of cards come down like it did in 2008 and 2009, although no matter what TV people might tell you, guests, all rallies eventually end spectacularly with a crash. I don't necessarily know that we're in that situation just yet. The market isn't necessarily down even 20% here from the high. It's also, believe it or not, it did lose the trend line from the 2011 lows, but we are still within the guise of an uptrend from 2009. If you connect the 2009 to the 2011 lows, we're not even there yet. So it's a little early, I would say, to predict that the market is completely over, but I will say I am seeing some very, very bearish signals that has me wondering. I mentioned in the weekend review video, and I'll do that again briefly now, that SPY has a couple of key levels coming up, and today was a test of one of them. I had talked about retesting the 182.40 and with a likely overshoot, which we had perfectly predicted, and a rally. So today's rally in SPY off the lows still closed negative, not good. It didn't close within yesterday's range, not good. It did, however, kind of close just at the tail end of the day before that's range. So it has some potential, but I still believe is suspect. We didn't close above the 186.93. I would have felt a little bit better going in tomorrow if we would have had that closure. So there's a few other levels if we lose there. The good news is I shouldn't say it's good news because it's still pretty far in terms of point terms, but the reference low I've been eyeing is 173.71. There's also on the weekly chart, I was sort of looking at the, it's kind of crazy how I got to this. I was looking at the weekly chart, and I was looking at the 2007 peak and that rollover retest and then the eventual demise of the crash of the market. And what had happened then, and I don't know if we're going to set up for the same thing here, things don't necessarily always repeat that way, is we retested the 200-week moving average. It was a slight overshoot, and that would be, I guess, the move to the trend. You had a very substantial rally back, all the way back to the 50-week moving average. We are now on a weekly time basis. And after that 50-week and basically 150-week convergence, that failure led to the crash. So we're kind of, I wouldn't say we're, I don't want to say we're okay, because history never repeats, and yes, someone said that it rhymes. I don't know that that is one potential scenario. That's all I want to say. I don't want to get people totally panicked out of their minds. It's very possible that the market recovers here, and we could even have a W pattern and could rush to new highs. I don't hear anyone talking about that. I will say this, I have run a few surveys on my stream. While people are significantly more bearish, I still think that there is unfortunately still a lot of optimism, some hope and praying going on. So I'm going to talk to you a little bit differently today, and I'm going to give you some ideas. We'll go over some of the names that people mentioned, but I'm going to give you a couple of things up front that I think will help save you from blowing up your accounts. And that are these three things. One, if you're not already doing it, please beta weight your portfolio. Sorry, I don't have commercial breaks. Not yet, anyway. So what you need to do is beta weight your portfolio, and I would suggest most of you, given the names of the stocks that people mentioned here, these momentum names, FANG and such, is beta weight yourself to the Qs, the QQQ. You can do that if you're on TOS. You just go into Monitor. Then there's a little tab up here, beta weight, and then you just type in the QQQ. You go down, you take a look at your delta, and that should be the dollar amount that you will either make or lose for every point that is moved in the Qs. You can, if you're in more conservative names, you could use the SPY as well. You could really use whatever you want. You could even, if you really want to, I don't want to say balls to the wall, but I will say that is the IWM. It depends on really what you're in. I usually use the Qs because I usually traffic in these high momentum tech stocks. Anyway, that is one thing you should do. I would also suggest reducing size, using smaller size. you're getting very large moves. You have a VIX that is exceptionally elevated here. We didn't close on the highs with the VIX. It actually only, I should say, only closed at 27.59. But that is, given that it had been to 32, that is relatively low. But anything really VIX environment that's above 25 to me still has crash risk on the table and is also very iffy. It also means that you're going to have more exaggerated moves in the market. So I would say get your size right. I also think that people haven't adjusted to the fact that we might be in a downtrend. And, it's like I said, we haven't broken those 2009 to 2011 trends, so it's a little too early to say we're in a downtrend, but we are starting to make lower highs and lower lows, and I do realize that the market is exceptionally oversold in the short term, but in the larger picture, there is, believe it or not, a lot more that can go wrong. I've said for a while that we never retested the 2000 and 2007 tops. That's around the 155s to 157s. I don't necessarily know that we're going there, but it is very, very possible. We haven't tested even any of the fib retracements. So that was the breakout. I've stipulated that we are now, a lot of the gain, particularly the one in 2013, I would say the one from 2000, excuse me, sorry. Get very dry when you're talking continuously. That rally might need to be taken back in its entirety. So we're really going to have to see how the Fed handles this. I'm not very pleased with their behavior, and they're still talking about rate hikes, which to me is like completely asinine. This is like the people that played the music to keep the passengers calm on the Titanic. I'm just reading some of the comments here. Yeah, I am pretty. I hate to say it, I'm a little bit more bearish here. I don't necessarily know if now is the time to rush out and load up on puts. With the VIX being this high. If you're going to be playing, and you want to play for downside, or even if you want to play for bounces, I highly recommend. This is another tip here. When you're in a high VIX environment and you're buying premium. Even if you're playing for an upside, you get the direction right, you could still have a losing trade. Why? Because not only direction is important, but implied volatility is even more important in many instances. So, if the market is down severely and you buy calls and you get the rally you're looking for, you could maybe break even or lose money or not make as much as you thought. The way to kind of counter that move is to turn it into a spread. Meaning you buy a call or you buy a put and you sell one higher with the calls or the puts lower. That to me is a good way to play. If you're looking to play, if you have longs on and you want to kind of still have the probability of some upside but want to protect on the downside, I like using put spreads or put ratios, or maybe to sell out of the money calls to finance those put spreads as hedges. I also like creating synthetic butterflies, meaning if you're long shares, you sell calls and then buy higher calls. So you're kind of, you'll be pulled out of your stock if their stock rallies, but you could at least participate in some of the upside because you have the longer out of the money calls. These are all I wouldn't say parlor tricks, but these are really tricks to kind of maximize some gains and minimize some of your risk. And in this kind of an environment, you want to minimize risk. I do think that the market will probably, I do think that there's potentially some more downside. I don't know that we won't rally first. I do think it would probably be, it'll probably be a situation where we get a move lower and then get a responsive move higher, but it could also work in reverse order where we get the move higher and then lower. So this is just a matter, in my view, of semantics. And I think a lot of people are long and they're waiting for rallies to kind of get out into. That's why you see these gap ups that fail. I think there's a lot of liquidation. People who are in these like debt instruments can't necessarily get out so quickly, so they sell stocks. Or they short futures. There's tons of ways to hedge the market. Our U.S. markets here are very liquid, and I think that they are being used as sort of like a piggy bank. So let's get into some of the names that people have asked me about here. I do have to kind of boogie in the next couple of minutes. I have some plans today, so I'm going to go through them. I'm going to use my discretion here with some of these, and I'm going to try and go through them quickly. Let's start off with FANG, but lead off with Apple. So Apple today, I had said that we really needed a green apple for the market to rally. It closed marginally higher. There is some key support coming in. I've said between 95 and 92 is important, so we haven't really broken the tail line of the support yet. It did hold partially one of my down channels. I would have liked to have seen it kind of hit the 200 MA, the 92, and then rally. I would have been actually a little bit more constructive on a move like that, but it seems to me like there's a lot of fear built up. I know a lot of funds still are along this, and tons of people who are public, the public owns this. It kind of, to me, I hate to say it, looks almost like a head and shoulders breakdown. The neckline, we are well kind of through there. I mean, there's a couple of ways you could draw that. I would say 104 to like the 10, yeah, the 10. Let's see if we want to be really, really spot on technical here. 104.63, and I've been saying for a while anything below 103.74 is bearish. So we broke that. We haven't had really on a separate leg a check back there. Maybe you get that on the earnings where it's sort of a gap into resistance. I do think the lower Apple goes into earnings, the more it will set up for a long trade. I do see primary downtrend, though, coinciding. It depends how fast it gets there. Like if it were to do it today, it would be 83, but by the earnings, which are actually fast approaching, the 26th. So by the time we get there, it might be closer to the downtrend line. Which is the 85. That's also the big 61.8. There's loads of levels below, like 75 is basically a gap fill from where this all began. So, like I said, I would actually prefer, I mean, they'll probably rally it ahead of the earnings, and that to me will kind of muff the setup, but if there is some panic below there, then I think there would be, I think that would be a great opportunity to kind of play Apple for a bounce, and then maybe even flip short after you get that pop. So that's Apple. Let's just do FANG in order. Let's do Facebook. So Facebook is doing kind of what I said it would do. How did we close today? I didn't see the dead close. All right, closed all right. I was looking for a retest of like 91s to 92s. We held there. We had the bounce. Then we had today was a big hammer breakdown. We got as low as 89. I've been looking for 86s or 83s really as a great place to kind of load the boat. I do believe you could start selling, some. Now that we're down ahead of earnings, you probably could sell some puts on weakness, particularly when IV is up, as a long proxy. So that's what I'm thinking. Longer term, bigger picture, I am very bullish on Facebook, but I will say this. It's run a lot. There is, a lot of risk to multiple contraction. That, I think, is one of the issues the market has been facing in general. As the Fed has kind of shifted policies, there's some multiple contraction that is taking the tape down. So those are my levels. I like playing that with put ratios if you want to kind of play the chicken hawk way to get long. That is my views on Facebook. Anything below, I will say this though, anything below 99.24 is still vulnerable to lower prices, so keep that in mind. Amazon. So this to me was very frustrating. I was looking to buy it right on the 61.8 fib today, which was 44.76, and we missed there and had a pretty large rally. That is really annoying. The good news is it basically held some important technical levels. The bad news is that if we do get to the 61.8 now, it's not a buy anymore because we were close enough there already. If we lose there, then we're going to be looking at primary trend. If it were to happen tomorrow, that's like 505. I don't know that that is going to happen tomorrow. The best thing, in my view, that could happen here is for Amazon, again, to continue lower, right to that primary trend, sit right on that trend for earnings, and it sets up for some type of a right or right out long. And if there is a snap or Ruski, you can play it as a right or right out short. Really very simple. Again, this will probably not play out this way. It'll probably rally ahead of the number and make it harder. But I do believe they had a good quarter and probably is a long for earnings, assuming we are lower into it. One of the reasons that I'm very cautious on the market is the curious case of Netflix. So Netflix reported earnings after hours yesterday, and the stock had a pretty decent pop. And it wound up being down really, really large, huge at one point today, down to 97. Wow, I had seen it at 100. I didn't see it at 97 today. I guess I was busy with some other stuff. Also, a little bit, also I would say, exhibiting some weakness. You know, I've said, but as long as it's below 115.03, it's vulnerable to lower. Then the numbers were 110, 103, 88 to 105. And today we looked below. We kind of closed, I guess, marginally okay. The closing was 107. I really would have liked to have seen that up above the 110. So it's still a little bit vulnerable here. I would be a little bit careful with that one if you're long. Stocks usually, when they can't go up on earnings, have troubles. Google. So Google got really close to the channel high. Today, it, for the most part, filled the gap, kind of to the top of it, not a complete fill, and held a trend line, not the main trend line, which is real low, a lot lower. If it happened again tomorrow, which I'm not expecting, would be 600. But it held that gap. This is sort of what it did the last time. Filled the gap, ran for a few days, filled the gap, and then, kind of sputtered along to make higher highs. So that's the story with that. All of these stocks, like I said, I'm really cautious on. I'm hoping, again, this one also is still down more ahead of the earnings, because I do think that there will be tradable rallies, considering these are all coming from all-time highs. So right now is sort of the must hold if you are long the Goog against that gap fill. Someone asked about FCX. I'm just going to jump to that. That is basically a lottery ticket at this point. They have a ton of debt, and they are reliant on commodities being much higher. If you want to play, for a rebound, Carl Icahn is in there. If you want to just kind of speculate and buy a little bit of it, go ahead. But also be prepared that it could be a zero. That's the reality of that stock at the moment. Exxon, skip to oil quickly. So today it kind of saved itself marginally. It closed this was closed pretty crappy. At one point these stocks were down like huge today. You haven't really seen that much bloodletting in the Exxons and the Chevrons, but was down today. I think people were getting a little, oddly, why I think Exxon and Chevron were down so much today. Yes, oil, but believe it or not, I think IBM dragged them down because they're big components in the DIA, which is the ETF for the Dow, and I think that selling in that ETF dragged down a lot of the components, and I think Chevron and Exxon were hurt more than they might have normally been because of that, although the tape today was hideous. Let's get into Chevron is basically the same analysis. So I kind of killed two birds with one stone. Chevron basically held the 78.6. There is a minor gap fill a little bit lower, around 73, but this area is really key. It kind of needs to hold these lows, or we could have some more selling in there. But I'm sort of thinking that that's going to probably have, it may see lower, but there'll probably be a bit of a rally in there if we do get some relief in oil. We're going to have to see how that plays out. Like I said, the 25-26 area is going to be really key. Alrighty. Hertz Hertz. Someone asked me about Hertz. This is one I've been watching for a while. I know a lot of hedge funds have been in this, and they've had accounting problems. And the stock, wow, I haven't looked at this one in a while. Last time I looked at it, it was in the teens. The stock was like touched $8 today. Roll the dice with that. I mean, to me, I see some minor support. I didn't get an alert today because it didn't trigger, but I had 70.80 marked off as a key level. I don't know why I have an alert down. I guess that's a little bit. Oh, that was the reference low before that run. So I guess if you want to try it long versus 70.80, you can. But accounting irregularities or trouble. This again is going to be one of those kind of lotto tickets. I think. I think they're also being hurt by a secular change with Uber and Lyft and Via. I don't really know that many people who are. I guess I live in New York, so I don't really know that many people besides me that drive cars. But Uber and Lyft and all these things are huge, and they are definitely taking share. So that's the story with that. All right. JetBlue, someone asked me about. That's the one of the ones I've liked the most, although it had some poor highs. It's had some responsive selling. If you're long, you have double hammers back to back on the weekly actually. So if you're playing long, I would say today's low has got to be your stop, or you can initiate a short below there. If you want to play for continuation, the flash crash low was 16s. That was also a 61.8 in the range. And then you also have $12.55 was sort of a breakout, and also the big 61.8. If the entire rally is going to be repealed, I don't necessarily know that that's going to be the case. I mean, you're looking at like $7. So I like it long if you want to play against today's low, the week's low, today's weekly low. Let me just go flip back to the daily. If you want to play long against that, I will countenance that. But if you lose the low, it's a short. Sorry, that's just it is. I think we're gonna. Let me just do one more. Since I didn't cover these in the weekend review, I ran out of time. I'm going to do them quickly. Disney. So Disney, also one of these ones where there's a lot of fear of secular change. They're also very economically sensitive with their theme parks. So you had a $90 was the reference low. There'll probably be some responsive buyers there for a rally, but I would look to be shorting this sucker if you could get a gap fill anywhere close to that 105. That to me would be a rather impressive area for it to recover from, and probably would be, in my view, a good red or red out short area. I do think that this probably has lower to go, though. All right, so let's talk quickly about the indices again, and key levels, and we'll wrap. So with SPY, very simple. It really needs to hold this 180, 192-ish area. That was a key reference low. 180, 192 to 182.40. Anything below there to me is vulnerable. Like if we lost today's low, then I think we will see that 200-week MA and probably the other reference low and the primary trend down in the 173s. If you can get back up above today's high, then we'll probably have a rally to probably easily to 190, I would think, very, very, very easily, and then probably start to take back. If the market could really, I don't know that we're going to be able to rally this hard, but if we could get somewhere between like the 197s and 200s, I think that will set up as a good right or right out short. My main short, I mean, if somehow, some way that we could get back up to 204, 205, that is a major short. But I do think that we will, if you could get back up into some of that real range breakdown area between the 197.86 and the 200, that would set up for a short. So I'm either looking for a long really down by the 173 or short back up above there. IWM is a little further along in the process. It did bounce. The close today was a little bit, I guess, better than SPY's because it did close into the prior 2 days ranges. 195 isn't really, it's still closed below channel. 184.32 to 84.32 to 85.74 to me. That was the 2007 peak. I would love to play for put ratios or just to play long if we can get down there. I know it's a lot of points lower, but it's a little bit closer than the move than it would be with via SPY. The Qs still kind of holding up. I mean, they're still within the triangle. Today it did take out minorly the flash crash, the bounce low. Still holding the regression line that I have, the downward regression line with the body, not looking nearly as bearish. 96.59 is the 61.8 from the flash crash, the real flash crash low. Really key to hold. If we lose there, then we might want to retest there down at like the 85s. Primary trend is a little bit higher. It's closer to that 90 level, so I would like put ratios. I think you could play put ratios there. If there is some type of a rally back, 105 I had said was an important level, and 107 is sort of where the big volume picks up. So that could be some good right or right out action. The real breakdown, though, like I said, took place from 109. So that to me would be a really a pretty good area if you want to test somewhere in that range. Maybe sell some calls actually. Anyhow, that's my story. I'm sticking to it. I have to book. So if you're not following me, follow me on Twitter. It's at Justin Pulitzer. If you missed this or came in late or want to watch it again, if you like my my red North Face hoodie, which I'm a big fan of, by the way, you can rewatch me on my YouTube channel. That is Justin Pulitzer Trades. That should be up later tonight. I would normally upload it right now, but my phone needs to be here to do that, so I will do it later on tonight. It'll probably be live later tonight or tomorrow. Anyhow, like I said, we'll have it. The world isn't ending, I assure you. There will be brighter days, but unfortunately, there may be some darker days too. So just stay nimble. Try to keep your size down, manageable. You don't really want to blow out your account. Definitely do some hedging when you can on some of these rallies. If you're overly long, if you're overly short, don't get too complacent. There could be a really big rip-roaring rally. The key to really being good and short is having good trade location. If you're really pressing lows, you're not going to have that location, and you could be a victim of a major short squeeze and still be right with the price going lower. So you really want to kind of short the rips and not necessarily buy the dips here. So careful. I would get more, I guess, yes, somebody had said I was overly bearish. I will be more constructive if I start seeing higher lows and higher highs. That pattern needs to play out. Someone asked me the other day about a few stocks, and I basically said the same thing. You need to see higher highs and higher lows. Anyhow, let's have a good rest of our week, and cheers.